All of that. Let's carry this conversation forward. We have Mayuresh Joshi, who's a fund manager, Angel Broking, joining us on the show right here. Let's talk about these markets right now. Mayuresh, good afternoon to you. The big story, of course, has been the kind of crude woos that we're seeing right now with those oil retailers very much falling on the back of reports of the government asking for absorption on that price hike. But before we really get into that, how are you looking at this day? Because we are looking at how range-bound it is, as well as, I guess, how certain sectors seem to be playing out there.
Afternoon, Fatima. So largely, I think three factors is what will determine the course of the markets. Primarily, I think crude, as I've time and again pointed out, can be the outside joker in the pack. So if the prices stay above $70 a barrel and stay above that for the better part of the next financial year, you're obviously going to have implications both in terms of our fisc and the current account deficit actually going out of balance. And at the same time, I think the CPI inflation will have an added trajectory. So I think anything between 0.3 to 0.5 basis points can get added. So that does not help the economy from a macro perspective. The second element, obviously, with the uncertainty surrounding crude can be what happens with yields. The fall in yields that we probably saw post the announcement of RBI on the inflation trajectory and the lower government borrowing program for the first half of the current financial year, I think did have some amount of a softening effect. But largely, I think the yield movement, again, is something to be seen. The yields have again moved up very, very sharply in today's trade, and that does create some amount of upheavals as far as the cost of borrowing is concerned. A lot of banks have probably raised MCLRs. So I think yield is something to be watched out for. And the third critical element for the markets is obviously going to be corporate earnings. So as the earnings season kicks off, it's going to be relatively muted this time round, but the expectation is that the base will probably be far better going forward. So if we see some compounded annual growth rate in earnings over the next few quarters, I think then the markets will re-rate themselves. But considering all these factors and our own local political scenario, my own sense is that the markets are probably stuck in a range over the next few weeks or months. So large element is to probably just cherry pick your stocks at this point of time.
Cherry pick stocks at this point in time. Indeed, this juncture where the markets are clearly struggling to find direction, that's sage advice. But right now, Mayuresh, how would you look at downstream companies with the way crude oil prices are going, with all this buzz that we're hearing about the government wanting to control fuel prices right now, and indeed what Aramco plans to do in India? All of these factors in the long term, how do you think is going to play out as far as oil marketing companies go?
No, so a large element is dependent, Vikram, on two key variables. A, obviously the price of crude, and B, I think how the rupee moves against the dollar. So if one really assumes that what you're probably seeing in terms of Brent prices at $70-odd not sustaining at these levels, and oil prices clawing back to that $60-68 kind of a mark or a range, you're probably less assumed that the dollar will not appreciate, or the rupee will not depreciate too significantly against the dollar. Now the second element, if the adverse situation happens and oil stays above $70, as I said in my opening remarks, it obviously has an impact in terms of both the upstream and downstream, because upstream companies still $70 enjoy the benefit of gross realizations being directly passed through because of no subsidy sharing and no under recoveries. And similar is the case with OMCs. But as soon as it crosses that $70 mark and stays above that, the kind of budgeting that has been given specifically in terms of fuel subsidy, I think the government will have no leeway to take more hits on their own balance sheet. So these companies will have to do the forbearance in terms of any elevated crude prices staying above $70. Obviously, it affects the marketing margins of downstream companies in a significant way. So I think the sluggishness in terms of marketing margins not compounding or increasing with oil prices staying at elevated levels plays on the overall consolidated SOTP earnings for OMCs. The other element obviously is the kind of cash flows that they generate if the prices stay at elevated levels. So the operational cash flows also get impacted because of elevated working capital requirements, which were not existing over the last few years. The third element obviously is also the kind of capex that these companies are doing. So I think the cash flows that come through internal accruals is going to sufficiently fund for their capex programs. So somewhere I think sluggishness might happen as a risk factor. And this is what the markets are perceiving. So I think the kind of yields that OMCs give out between 4.5%, that probably also comes under the question mark if they start staying above that level. But our own presumptions, very frankly, is that 60, 68 is the range that we are looking at. We're not looking at oil sustaining above 70. We're not seeing a huge depreciation of the rupee against the dollar for the better part of the financial year. Though a short-term intermittent effect is possible, and that can affect near-term earnings. But long-term earnings should improve. The dividend yields should be far more stable, and the kind of capex programs they're doing for improving the refining capacities should play out very, very positively in terms of the refining margins. So again, significant declines is what I look at. IOC probably remains one of our preferred picks, but one really needs to wait for declines and have these near-term pain points taken out, which in my opinion should happen over the next few weeks, and that will give better entry points for long-term investors.
All right, I'm going to, Mayuresh, just want to come to you. Piyush was giving us an extensive review of CLSA's take in terms of its own buy rating as well as the target price and reasons that they're citing 1125 per share. What are your thoughts on that as well as the kind of timelines we're looking at when it comes to benefits of other verticals?
So again, Fatima, I think you need to break Reliance into two parts. I think their core businesses of petchem and refining, which have been doing exceptionally well. What you're probably seeing in terms of Singapore GRMs, at least at this juncture, is that the light distillate yield has probably moved up significantly. So Singapore GRMs and Reliance GRMs more or less in tandem, and again I think the premiums that Reliance gets from its core refining operations substantial. Again, I think the commissioning of two key projects should largely be over, and that should again give sufficient amount of impetus to the petchem business. Coming to the telecom business again, the kind of capex that they have pumped into the business over the past few years, the kind of subscriber base that they've created, and the kind of revenue market share that they are gaining quarter after quarter substantiates the fact that the kind of capex requirements that Reliance had put through in this business has started yielding results. Now the key point here is how are ARPUs panning out for the same, and ARPUs probably are relatively better compared to the existing incumbents, which have probably seen down trading happening because of bundling of packs, their interconnect charges, and that is what has impacted their overall revenues as well. The third element in terms of the ongoing capex, so in the core businesses of petchem and refining, I think the kind of capex that goes through in the next few years is going to be very, very limited because the majority of the capex is behind them. Similarly for the telecom part of the business, and even if one really assumes them to come out with fiber band or broadband as we call it, I think the yield in terms of results should start coming out after the next few years. So I think the capex requirements will be immediate, but the return on equity for all these businesses will come back-ended after 3 or 4 years. How the entire scenario pans out at that point of time is a totally different ballgame. So at least at this point of time, I think because the majority of the capex is behind them and the incremental capex should be far more limited both to the telecom as well as the key refining and petchem verticals, I think the ROE should see a significant amount of improvement over the next 2 years. The added kicker obviously comes through any value-added services and the capex that they're doing on the broadband part of the business, which can yield results, as I said, after the next few years. So I think I retain my positivity on the stock. A clear disclaimer, we own this stock in our funds.
Fair enough. So that's your comprehensive take on Reliance Industries as a stock, and the one sector that we are concentrating a lot on today is the metals pack for obvious reasons, because they have been shining in the recent past, and we're seeing that today as well. 1.5% up move as far as the entire pack is concerned, led by Vedanta, Nalco and Hindalco. So clearly the action is on aluminium. Mayuresh, what do you make of this move that we're seeing within the metals pack, which is showing so much of attraction for for aluminium. Do you think the world is moving on from steel and making strides towards aluminium, and that is why we're seeing that much more action on that particular front? And is that likely to sustain? Would you bet more on stocks like the ones we just mentioned?
Oh yes, I think, Vikram, and the recent move that you've probably seen with US sanctions happening on Russia and the kind of commentary that has come through from Rusal, I think that has given a spike in terms of aluminium prices. How sustainable that is over a longer period of time is a question mark, because ultimately the dynamics do move in the favor of how demand-supply dynamics move. The second element in terms of the inventory requirements globally. So again, I think these two factors will determine the commodity prices going forward. But at this point of time, both aluminium and alumina prices have moved up quite significantly. Having said that, the consumption in terms of auto demand, specifically in terms of aluminium requirements, is going up. And the management of Hindalco has made it very clear a few quarters back that the auto component share will reach 25%, which itself is a significant traction and something that we are seeing in terms of a paradigm shift as far as the auto industry is concerned. The second element, both in terms of operating cash flows for its overseas business and the kind of capex that is required, I think the operating cash flow should be quite significant, and even the domestic demand scenario looks perked up. So in that sense, again, the kind of input cost inflation that you've probably seen both in terms of iron ore, hard coking prices, bauxite prices, is a pass-through effect in terms of selling prices actually going up. So large element in terms of aluminium prices probably staying in the range is how I would put it. But my preferred pick probably still remains Vedanta because of its diversified nature. The zinc price is still expected to remain firm and improve here on. It's also got the aluminium part of the business. Any developments related to captive mines is a trigger for the stock. The oil and gas business with optimization achieved in that sub-segment augurs well for the stock. With crude prices expected to stay in that range, it obviously benefits over the long-term perspective, and a very, very healthy balance sheet. So I think metals, diversified play, Vedanta, and a hold rating continues on steel players, where our belief is that the numbers should be extremely strong, at least for Q4. So Tata Steel, JSW Steel are clear holds, at least over the medium term.
All right. That, of course, is the view that you have when it comes to this particular space. Thank you so much, Mayuresh, for having joined us for this conversation. And wonderful to, as always, have you right here on the show. We're going to continue to talk.